Something massive just happened in the US markets. And almost nobody understands what it means, but hedge funds do. And they're absolutely terrified. A sudden wave of panic selling just triggered the exact chain reaction hedge funds prayed would never happen. Because while everyone is staring at tech stocks crashing and inflation numbers rising, silver just flashed a signal we've only seen twice in the last 50 years. Both times, it came right before historic price explosions. 1979, silver went from $6 to $50 in months. 1980, silver went from $18 to $49 in weeks. The same signal that appeared before both of those moves just fired again. Why did the panic begin? Who triggered it? Why are hedge funds scrambling to cover positions they've held for years? And why is silver suddenly at the center of everything? Stay with me, because what I'm about to show you in the next 60 seconds will change how you see the next 6 months of the US economy. Let me show you what just happened. Last week, something broke in the US financial system. It wasn't dramatic. It wasn't announced on the evening news, but it sent shockwaves through institutional trading desks. What actually happened? The overnight repo rate, the interest rate banks charge each other for emergency overnight loans, suddenly spiked from 0.8% to 4.2%. That's a 425% increase in borrowing costs overnight. Why this matters? When banks trust each other, they lend cheaply. When they don't trust each other, they charge emergency rates or refuse to lend at all. This spike means banks are terrified. They think other banks might not be able to pay them back. The instant reaction. Within hours, big money started moving. Treasury yields spiked as investors fled to safety. Tech stocks dumped as hedge funds liquidated positions to raise cash. Corporate bond spreads widened as credit froze. Commodity futures showed unusual volatility patterns. This wasn't retail investors panicking. This was institutional money running for the exits. The hidden signal. But here's what 99% of people missed. While everything else was selling off, physical silver demand spiked. Coin dealers reported their busiest day in 18 months. Premiums jumped $4 in a single trading session. Delivery times extended from 2 weeks to 6 weeks. Smart money wasn't selling silver. They were buying it. Why retail missed it? You were watching the wrong screens. CNBC was talking about tech stocks. Bloomberg was focused on the Fed. Twitter was panicking about recession. Nobody was watching what the real players were doing in the commodity markets. Engagement moment. Do you remember the last time we saw this exact setup? Tell me in the comments if you think this repeats 2008 or 2020, because what happened next reveals the real story. But this isn't about the panic itself. The real problem begins when you see how hedge funds were positioned when the panic hit. Hedge funds have been running the same playbook on silver for over a decade. Short the futures, suppress the price, accumulate physical, repeat. It's been the perfect trade. Until last week. The positions they built. Major hedge funds and bullion banks held massive short positions on COMEX silver futures. We're talking about concentrated shorts representing hundreds of millions of ounces, far more than they could ever deliver if forced to. They were betting silver would stay suppressed, that industrial buyers would stay complacent, that retail investors would give up. Why? The panic destroyed their strategy. When the repo rate spiked and liquidity dried up, their entire strategy collapsed instantly. Here's why. Problem, Triggertimasber 1. Margin calls. When markets panic, exchanges raise margin requirements. Suddenly, hedge funds need 2x or 3x more cash to maintain the same positions. But cash is exactly what disappeared when the repo market froze. Problem number 2. Forced liquidation funds that can't meet margin calls get automatically liquidated. The exchange closes their positions whether they want to or not. In a short position, liquidation means being forced to buy. Problem number 3. Physical delivery risk. The panic triggered something hedge funds didn't expect. Industrial buyers started demanding physical delivery. Remember, these shorts are naked. They don't have the actual metal. If delivery requests spike, they're completely exposed. Historical parallels. This is exactly what happened to the Hunt brothers in 1980. They tried to corner the silver market through futures. When margin requirements suddenly increased, they couldn't maintain their positions. The whole strategy imploded. But this time, it's reversed. This time, it's the shorts who are trapped. The evidence is appearing, physical premiums rising sharply, proof of delivery pressure. Open interest declining on COMEX, proof of forced position closures. Bullion bank trading desks working overtime, proof of panic behind the scenes. Engagement moment. Be honest. Did you ever think hedge funds could be caught off guard like this again? Drop your thoughts in the comments. And here's where the story flips. Because the move they feared the most is the exact move that sends silver into overdrive. Let me show you why silver is uniquely positioned for an explosive move. The supply-demand imbalance. Global silver production. approximately 830 million ounces per year. Global silver demand, approximately 1.1 billion ounces per year. That's a 270 million ounce annual deficit. Where's the difference coming from? Existing stockpiles, vaults, recycled material. But those stockpiles are finite, and they're draining fast. Industrial demand explosion. Electric vehicles need 25-50 grams of silver each. EV production doubled last year and is doubling again. Solar panels need 20 grams each. Global solar installations are at record highs and accelerating. AI data centers require silver for high-performance connections. AI infrastructure spending is growing exponentially. 5G networks need silver, defense systems need silver, medical devices need silver. This isn't discretionary demand. Companies can't just decide to use less silver. The technology requires it. COMEX withdrawals. Accelerating. Over the past 6 months, registered silver inventory at COMEX has declined by 40%. That's physical metal being pulled out of the exchange system and into private hands. Why? Because industrial buyers and smart institutional money don't trust the paper market anymore. The price disconnect. Here's the contradiction that proves manipulation. Paper silver on COMEX, falling or flat. Physical silver premiums, rising sharply. One market says there's too much supply, the other says there's not enough. Which one reflects reality? The one where actual metal changes hands. Miners, reducing output. At current prices, many silver mines are barely profitable. Some are operating at a loss. When prices don't cover costs, mines shut down or reduce output. This creates a doom loop. Lower prices, less production, tighter supply. Eventually, explosive price increase. Countries are hoarding. China is stockpiling silver for its solar and EV industries. India is accumulating for industrial use and cultural demand. Russia is buying as part of its de-dollarization strategy. When countries hoard, the available supply for everyone else shrinks dramatically. Why hedge funds can't suppress. During panic, under normal conditions, they can manipulate through paper contracts. But during a liquidity panic, the paper market loses credibility. People demand physical, and there's no way to print physical silver. Engagement moment. If you're watching this part, tell me, do you think silver hits $50, $100, or $200 first? I want to see what this community thinks is coming. But everything I just said is nothing compared to the next chart, the one that shows exactly where silver goes next. Let me show you the technical setup that has hedge funds in full panic mode. Historical pattern recognition. Before the 1979 explosion, silver showed this exact pattern. Long consolidation at suppressed levels, declining open interest on futures, rising physical premiums, sudden volatility spike. Before the 2011 spike, silver showed this pattern. Sideways price action while fundamentals strengthened, exchange inventory declining, short position concentration reaching extremes. Liquidity event triggering the breakout. We're seeing all of these signals right now, simultaneously. Current technical indicators. The silver chart is showing a massive coiling pattern. It's been compressed in a narrow range while pressure builds underneath. RSI is showing bullish divergence. Price making lower lows while momentum makes higher lows. Volume is drying up during the suppression, which is classic pre-breakout behavior. Open interest collapse. This is the big one. COMEX silver. Open interest has dropped by 25% in the past month. This means positions are being closed, shorts are covering. The paper game is unwinding. When open interest collapses while price stabilizes or rises, it signals that the manipulation is losing control, the short covering cycle. Here's what happens when shorts start covering. First short covers, price ticks up slightly. Next short sees the move and covers. Price jumps more shorts panic and cover. Price explodes. It's a self-reinforcing cycle, and we're in the early stages right now. Liquidity crunch, creating forced buying. The repo crisis means hedge funds need cash urgently. They're closing positions across all markets. But in silver, closing a short position means buying. So the very crisis that started this is now forcing them to buy the asset they were trying to suppress. Why this is a nightmare. Setup. Hedge funds are trapped between two impossible choices. Hold their shorts and risk massive losses if silver breaks out. Cover their shorts and trigger the very breakout they're trying to prevent. There's no good option. They're cornered. Engagement moment. Tell me, have you ever seen this pattern happen without a massive spike afterward? Comment below. I'm genuinely curious if anyone can find a historical example where this setup didn't result in an explosion. And now we reach the part the media avoids talking about. Because if the next event hits, silver doesn't just rise, it detaches completely from the paper market. There are several potential triggers that could ignite the final breakout. Let me walk through the most likely scenarios. Trigger number 1, COMEX delivery failure. If delivery requests continue accelerating and COMEX can't fulfill them, they'll either default or force cash settlement. Either outcome destroys confidence in the paper market. When the primary price discovery mechanism fails, price discovery moves entirely to the physical market, where supply is far tighter. Trigger number 2, Treasury market crisis. The US is running massive deficits. Treasury auctions are getting weaker. Foreign buyers are reducing holdings. If a Treasury auction fails or yields spike uncontrollably, it triggers a dollar crisis. In a dollar crisis, commodities, especially precious metals, explode as people flee paper currency. Trigger number 3, major bank exposure. If a major bank reveals massive losses from their silver short positions, it could trigger a broader financial crisis. Remember, these positions are concentrated. A few banks hold most of the shorts. If one falls, the others panic. It becomes a race to cover before everyone else does. Trigger number 4, geopolitical shock. A major conflict, trade war escalation, or unexpected alliance shift could send countries scrambling for hard assets. Silver, being both a monetary metal and strategic industrial commodity, becomes doubly valuable. Why these events force silver? Up foreign dumping. Countries sell U.S. treasuries and buy commodities. Sovereign panic buying. Central banks that missed gold accumulation pivot to silver. Industrial shortages. Companies that ignored the warning signs suddenly realize they can't secure supply. Physical delivery crisis. ETFs face redemption. Requests they can't fulfill. The paper claims collapse. The cascade effect. Here's what makes this so dangerous for hedge funds. Any one of these triggers starts the cascade. And once it starts, they can't stop it. They can manipulate paper markets under normal conditions. But during a crisis with multiple simultaneous pressures, their tools become useless. Engagement moment. What do you think will trigger the breakout? A bank event? COMEX failure? Debt crisis? Comment below with your prediction. Because once this trigger hits, hedge funds can't stop the explosion. And here's the part nobody is ready for. Let me break down the likely path forward in 2 phases. Phase 1, the short-term move, next 3-6 months. $35 resistance test, first psychological level. If it breaks clearly, it confirms the breakout is real. A $50 psychological barrier. This is where 2011 topped. Breaking above $50 means we're in new territory psychologically. FOMO kicks in. ETF inflows. Once retail investors see silver breaking out, money floods into silver ETFs. This creates additional buying pressure, short covering wave. As price rises, remaining shorts panic and cover. This accelerates the move upward. In this phase, we could see $50, $60 within months if the triggers I outlined actually fire. Phase 2, the long-term move, 6 to 18 months, $75, $100 range. This is where the industrial crunch becomes undeniable. Companies are bidding against each other for supply. Physical shortage. Goes mainstream, media finally catches on. Suddenly, everyone is talking about the silver shortage. Dollar cycle ending. If we're in a major dollar decline, silver could go much higher as it reprices against a weakening currency. Revaluation. Not speculation. At this point, it's not retail speculation driving price. It's industrial necessity and monetary hedge demand. The upper limit in phase 2 depends on how severe the supply crisis becomes and how weak the dollar gets. $100 is possible. $150 is not unrealistic if multiple crises converge. What happens to gold? This is the question everyone should be asking. When silver breaks $50, it sends a signal to the entire precious metals complex. If silver, the more volatile, more manipulated metal, can break free, what does that mean for gold? Gold could easily test $3,500, $4,000 in the same time frame. The ratio between the two metals will compress dramatically. The bigger picture. This isn't just about silver price going up. This is about a fundamental repricing of hard assets versus paper assets. This is about the market finally acknowledging physical scarcity in a world drowning in paper promises. Let me summarize the chain reaction. U.S. panic triggered liquidity crisis. Hedge funds trapped in massive short positions. Forced covering begins. Physical demand spikes. Supply can't meet demand. Silver explodes. Every piece is in place. The setup is complete. You're seeing this truth early. Most people won't understand until it's already happened. The window is small. Right now, you can still position before the breakout. Once phase 1 begins, prices will gap up. Premiums will explode. Physical metal will become hard to find. The time to act is before the crowd realizes what's happening. Final warning, hedge funds feared this exact scenario. They built their entire strategy on it never happening. But it's happening right now. The panic just triggered the move they can't stop.